A very warm welcome to the Risk Reversal podcast on this Monday, September the 15th, a day, by the way, where we have learned that the Milwaukee Brewers of the state of Wisconsin have clinched a playoff berth. Congratulations, Elizabeth Thomas.
Thank you. Perhaps not a surprise to anybody. They've had the best record in baseball for quite some time now. But yes, clinched the playoff berth. It's all over my socials. It's very, very exciting. And coming at a time when the Packers are 2-0, it's like the state is on fire.
The state is on fire. You know what else is on fire? What a segue. The United States stock market, because as we're sitting here on this Monday, we saw an S&P make an all-time high of basically 6,620. Everything seemingly coming up roses. Even bond yields are seemingly cooperating over the last week or so. And that all leads us to, I think, and as they say, you don't want to bury the lead, what I think a lot of people have been waiting for, although rate cut is clearly a foregone conclusion. I think the commentary around rate cut and the potential 5 or 10% chance, and I think that's probably all that it is that they come in hard with a 50-point cut, which, by the way, I don't anticipate. I don't think the market does either, but that's what we're waiting for seemingly this week.
Yes, to be exact on those numbers, there is a 4.8% probability baked into the market that we will get a 50 basis point cut. I personally do not think we will. I don't think we need one. It would be a difficult thing to explain. That's the way I'll put it. It would be difficult for Powell to explain why he was doing 50. And another thing I would remind people of, because you mentioned bond yields, they did 50 basis points last year in September. And at that point, even if you're just looking at the market was screaming that it wanted a cut. Bond yields at that point, the 2-year Treasury yield was 200 basis points below the upper bound of the Fed funds rate. Today, the 2-year Treasury yield is only about 100 basis points below. So half as much below. The bond market is not screaming that it needs bigger than 25 bips. And the messaging around this, I think, will largely come in as this is the beginning of the normalization cycle, or at least a restarting in the normalization cycle, but that they're going to be data dependent, all the normal things that we hear from them. And they're going to leave themselves the flexibility if the data should deteriorate faster through fall.
Fair enough. And, when you talk about deteriorating of data, you're talking about the job market. And let's just for a second back up. I mean, you said that last year at this time, and it was September of last year, the bond market was screaming for a rate cut, and they got it. It appears as though, to me, that it's not necessarily the bond market, to the example that you just used. It's more the equity market that's screaming for it. And, I don't know what that's necessarily predicated upon. I guess it's some of the data lately that's been coming in somewhat soft. And, it's been now, again, leading indicators, lagging indicators. I mean, I think the majority of the data, if I were to really sort of be honest about it, has been sort of on the soft side. So I think that's what you're speaking about specifically.
Yes, the labor market is clearly what the Fed is concerned with right now, and rightfully so. It has softened considerably in the last 6 months, and they look at things like the average jobs added over longer periods of time, 3 months, 6 months, and they look at the average unemployment rate over periods of time, and those averages have come down largely because of many of the revisions that we've had in the recent even 60 days. So those downward revisions were big, and they've affected the averages. So the Fed is concerned about that. However, and this is not to discount the idea that if the unemployment rate hits escape velocity, we're in trouble. But right now we're at 4.3%, which, yes, is the high of this cycle. But it's not a concerning level right now. And I would argue it doesn't really get concerning until we start creeping towards 5. And that's when the Fed might get uncomfortable with it. And another thing to remind everybody about, this isn't just a rate meeting. This is also a meeting where we'll get a dot plot update and we'll get a summary of economic projections. So we'll get the Fed's projection for what inflation, unemployment, GDP growth, and the Fed funds rate will be at the end of this year. The last projection that we got was in June. And at that point, the Fed projected unemployment to be 4.5% at the end of this year. I say that to point out we've still got room to go before they're even at their own projection. So I don't think 4.3% is making them all that nervous. I think they're trying to find the balance of how quickly do we need to replace jobs and not lose jobs so that things stay relatively stable.
You mentioned the projections, and I don't know necessarily how this works. I think you do, but they've made the pivot. They were clear in Jackson Hole that they've made the pivot from, or the transition from being more concerned about inflation to being more concerned about the labor market. So are those forecasts predicated on, those concerns, or are they independent of that, if that makes sense, the projections?
I think they're probably connected. What you could see, and this is where we start to get into the what's going to happen with the market question on Wednesday. If we get this 25 basis point cut, to your point before, that's already baked in. That in and of itself will not be a surprise to anybody. If there is a major market moving piece of this, it's going to be either in his comments afterwards or in the summary of economic projections. And if you see something like the unemployment projection moving up, or the inflation projection moving up and no budge in what they expect the Fed funds rate to be, that could be slightly concerning. So if the unemployment projection moves up, we would expect them to cut further. If the inflation projection moves up, we would expect them to maybe not cut as much, right? So some of those intricacies and the way that those things are going to work together could end up being the market's either joy or disappointment on Wednesday.
Which is exactly why I asked the question, because therein lies the rub, right? If both those projections start to move, or if one moves more meaningfully than the other, then they've sort of, I don't want to say they've backed themselves in a corner, because they haven't done anything, but maybe the market, to your point, has backed itself into a corner. So if you were to see, let's say that 4.5 goes to 4.6, 4.7, but the inflation expectations remain the same or slightly higher, then you can see an environment where the stock market says, maybe it's not the scenario that we were hoping for in terms of the speed with which, or the amount of rate cuts they're going to get. Is that somewhat accurate?
Yes, and I would add to that the reason that they would be cutting. So if we're getting closer and closer to the data showing us that there still is a stagflation risk where you've got high inflation, tepid growth, and maybe unemployment that's also rising, then we've got a Fed that continues to be stuck between a rock and a hard place. And if you've got unemployment that continues to be a problem, then the reason for expecting more cuts may be because of weakness rather than just adjustment cuts, what usually get a pretty good reaction out of the stock market, particularly in the large cap space.
Are you fan? I know this is a rhetorical question. I don't believe you're a fan of arrogant people. Is that fair to
Is
say?
anybody?
Well,
Is there
well,
someone out there who
I
likes
think I
arrogance?
think some people out there find arrogance to. I am not one of those people. I hope I'm not arrogant. But if you think about New York, the nickname for New York is the Empire State, and if you think about that, there's a certain arrogance to that. I mean, the
I
Empire
see.
State. I mean,
Uh-huh.
really?
Yeah.
But
Well,
Empire Manufacturing came out, and we were talking about this prior to the show, but somewhat noisy. These numbers are always noisy. As you pointed out, regional can be impacted by a number of different factors, not least of which a weather pattern that might have come through for that particular period of time. But noisy or not noisy, again, this goes sort of to the soft and the hard data. I mean, these numbers continue to be eye-opening, but not alarming yet.
yeah. Okay. So the Empire Manufacturing Survey, this is just an index level, was expected to come in at 5. It came in at negative 8.7. So big miss in the wrong direction. But again, these are all regional, so they're only covering a certain portion of the country. They can be affected by a number of different things, and I wouldn't read too much into just one of these regional dots. The other thing is, I would say Mario and I post charts about this pretty often when they do come out. And the chart that you might see from us, and it's probably even said in the explanation, this is noisy, it looks choppy, is we try to average all of the regional Fed surveys into one line to try to get some sort of trend idea. It's still hard. And they really do not tell you all that much about the direction of the economy that you can't get in some of the other data that's already available. So I would regard a lot of these, if it's just one reading that's off, I would regard it as let's not pay too much attention to it. Don't act on it.
I agree with that, but again, what I've noticed over the years, not watching this nearly as close as you do, but the noisiness, to your word that you use, in these numbers are staggering. I mean, I think the prior number for Empire Manufacturer was up 12% or 12%, 8.7 negative this time. I mean the twos and fros are interesting, but I don't think necessarily anybody's trading on those things. And quite frankly, when you see a number like that in a nutshell, again, is it gives the Federal Reserve just one more arrow in their quiver, I guess. In terms of the rest of the week, in terms of economic data, not a lot. Leading indicators, though, on Thursday, I think are potentially interesting. I think they come out at 10 a.m. They're expected to be, I think, down 0.2%. The prior was down 0.1%. Should we be looking forward to that for any reason, or is that just another sort of lost leader?
That one is more important, certainly, and less noisy. Now, it's a combination of 10 different factors, one of which is the stock market. So it can be affected just by market movements and less so by the actual economic data. But there are a lot of different things that go into it. A lot of times what they're looking at is some of that hard data, manufacturing data, new orders, things like that, that would be looking a little bit more forward in the economy. And it is more of the hard data. So I think that's important to look at, important to watch. There are different components of it. The leading indicators is really obviously trying to predict what's going to happen. There's also concurrent indicators. There are also lagging indicators. So you have to take the whole picture into account. And this is definitely something to look at. And in fact, my first mentor in the business used to talk about the leading indicators a lot, and he put a lot of weight on them and thought that they were indicative of what was going to happen in the economy over the next, call it 12 to 18 months.
Well, we'll be watching that for sure. You mentioned Mario, who does extraordinary work. We've mentioned that a number of times. We did mention that in absentia when you were not with us during maternity leave, and nothing has changed. But I'm also pretty sure you've done work on some of the extraordinary moves we've seen in individual stocks. And again, I'm not talking about, small cap stocks, half a billion, billion, 10 billion, 25 billion. I'm talking about stocks that are approaching now $1 trillion in market cap. And I mentioned that obviously in terms of what we saw with Oracle last week, what we saw with Tesla earlier today, to a certain extent, what we saw with Broadcom in December of last year, when I think over a single day, the stock was up close to 30 or 35%. I am amazed by it. Again, we see moves like that all the times in certain stocks, but when we're talking about $1 trillion, $1.5 trillion companies, it's sort of, I think it gives me pause. Should it give me pause, or is that just sort of the world we're living in right now?
I think it should give everyone pause because it's a lot of volatility. Volatility counts on the upside too. So even when you see a stock that's up 20% in one day, that's really not normal. And it's also important to step back and look at how much it must take to send a stock that large up that much in one trading day. So the trading volume is humongous. And especially on the upside, in a period like now, you have to do this mosaic theory. So we're at 22 and a half times forward PE. We're in the 90 something percentile of valuations over history in the S&P. We've got a lot of different indicators, the Buffett indicator at an all-time high, right? There are all these different indicators that things are at least a little extended or frothy. And then you've got stocks, big stocks that on the upside are seeing these huge moves. To me, that means at the very least, we've got a chase trade. So people trying to run after it. Maybe I missed it until this point, or maybe I've got exposure to a lot of the stuff that people keep talking about being overvalued. And here's the next big thing that hasn't quite taken part yet. I think it's a reach for more upside. And the last thing I would say about this, and I talked about this a little bit last week, is that what I think is happening to investors right now is you see this upside in the market where I don't know how many all-time highs in the S&P now, 22 or 23 this year alone. When you see that happen, investors seem to be shifting their risk appetite and seem to be shifting what they think is appropriate for their own level of risk in order to fit the market. And that is always something that should give us pause.
You mentioned Humongous. You probably never saw the movie, but I think it was the summer of 1982. During, I don't exactly remember when, sometime it was my senior year, summer, I believe, of high school into college. A movie called Humongous came out. It was a bit of a slasher film. I think it was directed by a Canadian, but I somewhat digress.
No, I was born in the summer of 1982. So
well, there you
wasn't
look at that.
really
You're
watching
giving away your
movies
age.
yet.
moving along in terms of humongous. I don't want to say this is humongous news, and I don't know what to make of this. But President Trump was talking earlier today. I don't know necessarily where this one's coming from, but he I guess he is bothered by quarterly earnings reports from companies. I mean, again, and we all have come to expect every 4 times a year companies will report earnings, which I think is fine. But he seems to think that maybe the better thing to do is once or twice a year. Again, I don't have the specific details. I think if I were to sort of push back on that, I think we want to get quarterly results. I think maybe forward guidance is something that maybe should be frowned upon, especially if you don't have the clarity that one should necessarily have to make forward guidance. But I'm not going to equivocate here. What are your thoughts on that? Does it mean anything, do you think? Now, I understand what he's saying. He talks about the Chinese having 50 to 100-year sort of purviews, and they're looking out into the future, and we are very focused on the here and now, which I've said 100 different times. So I understand that, but are we going down a certain road with no longer giving quarterly reports?
I think it would be difficult to get the market used to that. Also difficult to get the SEC used to that. But but I think so there are good and bad things, and I don't know what his entire intention was behind it. I would agree that the forward guidance piece of it has at least had more impact on stock market reactions than maybe before, particularly right now as we're in this period of huge capex and most of the attention is being paid to AI companies or tech companies and how much they're spending on AI and how much they plan to spend on AI. Where we all have heard this story before. You see a company beat on the top line, beat on the bottom line, and either reduce its spending on AI or announce something in its forward guidance spending that actually sends the stock down when the results were quite healthy. So I do understand some of the merit in maybe not inducing that shorter term volatility. But what it would do is take information away from the market, because the other thing that companies can do in that quarterly guidance is get closer to where things might actually end up and message to investors, you know what, this is what we thought the year was going to look like, and now things have changed. I think this year in particular would have been important to hear that from companies. We started the year without tariffs. We ended the first quarter with a much different picture. So I think it is important for companies to be able to update investors when they want to. Now, maybe it's twice a year, or maybe it's only when they really need to. But the idea of, pulling guidance too, some companies just decide to pull guidance and it freaks everybody out when it's not always a bad message. Maybe they just don't want to send the wrong message. So there may be companies and CEOs that might actually support not giving forward guidance on a quarterly basis, but I still think we should get results, earnings results, revenue results on a quarterly basis.
I agree with that 100%. Again, I don't know necessarily what happens. Does that create a new level of
Mm,
volatility in the
right.
market? Do we, instead of a VIX, which is historically, let's call it 15, does that ratchet it up a couple standard deviations? I have no idea, but I understand the thought process behind it. I would sort of err towards forward guidance, but I'm not president of the United States.
Well,
What I am, no,
It
go ahead.
it it opens the door to an even more violent price reaction when the actual information actually comes in, right? So, let's say we do results in the beginning of the year, you get an annual result from a company, and then you barely hear from them for the next 11 or 12 months. When you do finally hear from them, what if the market reaction for the previous year was completely off base with what their actual results were? I think you set it up for actually more volatility, more shock factor than what we have now.
Yeah, I agree with that. And again, I think it would take. I think it would just ratchet up the historical vol, which again, not making comment one way or another, but I think that's something. I think there's an inevitability to what would happen if we went down that road, but I think we're probably far from it. Here's what I'll say about the world right now. And each year I like to look at these tables because I'm a bit of a geek and I like to see who's in the pole position, who's moved up, who's moved down. Yet again, the United States has the largest economy in the world. I think we know that. I think it's either side of $30 trillion, which, by the way, I think is about maybe 27% of global GDP ish. China coming in second, let's call it 20. But what we learned today with some of the moves in these stocks you use the term, I'll use it because somebody else will invariably use it, but the Magnificent Seven or Dan's Fateful Eight, the market cap of those companies have now surpassed the GDP of China. It's just a thing. I don't, again, I don't know what that means, but again, it's just the staggering nature of these numbers that historically we've never seen anything like it. By the way, as I mentioned, the United States is a $30 trillion GDP. So you could start seeing, a couple good weeks, and these companies are going to approach the GDP of the United States.
Yep. So actually, it's not even the Mag 7, it's the top 6. So the 6 largest companies now surpass the GDP of China. So that's NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta. It is amazing, and we will probably talk about this for decades to come. There will be studies done on this period and that maybe will be beyond both of our careers, but studies will be done on this period. The thing that I would say about it is it doesn't mean that it has to be over. It doesn't mean that it's going to all end in flames soon because this is so concentrated. But this sort of thing has happened before. So, into most of these big bull markets or big rises in the stock market, you do see concentration towards the tail end of it. Now, the tail end can last for years, but you do see increased concentration. Usually the top, let's say, 15 names. So, this is particularly concentrated in that top 10 or even less than 10. But this is a force that is normal in bull markets, particularly as they're getting a bit high, or high for the liking of people who are valuation conscious.
You mentioned the Buffett indicator quickly, which, again, to the extent that it even matters, has been flashing red now for a while. I think one of the reasons Berkshire Hathaway has underperformed the way it has vis-a-vis the broader market is because the market is penalizing Berkshire for having approximately 34% of their market cap in cash. So each day the market goes higher, I think the market's way of saying, you're not participating, we're going to punish you. And again, these are not timing indicators. None of these are. But, again, people talk about CAPE ratio. So it's the Shiller CAPE ratio, which is cyclically adjusted price to earnings, 10-year moving average, inflation adjusted. People look at these things. We're currently trading around 39. I think the mean or the median value of this thing historically, and historically is a long time, is about 17. And I think it's the second highest reading ever, behind that of sort of the dot-com era. Again, just one more data point that the market clearly doesn't care about, but I don't know how this reconciles itself.
Yeah, well, and I have no idea what Warren Buffett is actually thinking or what his team is saying about why they have that much money in cash. It could be that they would love to be able to invest it, but they can't justify investing at these valuations. So they're just forced to wait. Maybe it's a part of their process and their system, and it's just telling them on that valuation trigger that they can't do it. There is a famous quote by Warren Buffett. There are many famous quotes by Warren Buffett, but one that I think about pretty often is the stock market is a mechanism for transferring money from the impatient to the patient. So I have to trust that if there came an opportunity to deploy that cash at a lower valuation, whether it's him or somebody after him, I think that cash would be put to good use. In this environment, investors that have a lot of money in cash, hopefully it's in some sort of short-term treasury or money market instrument, you're still earning a decent yield. So it's not like it's completely dead. You're still getting income on that cash. And I wouldn't beat yourself up about it too much, but it is something to pay attention to, that, the Oracle of Omaha can't find good opportunities in this market. Maybe something that the rest of us should take into account.
Do you think if he was from another city, they'd still give him the Oracle thing, like the Oracle of Mequon, Wisconsin, or
No,
would
then
it
it
be
would be like
the
the
maestro of
master.
Mequon?
Yeah,
Right,
yeah. Their alliteration would still have to work.
right. So it's a good thing, I guess, that he's from Omaha, because that allows him to be an Oracle. That's probably why he hasn't moved. It's my sense, but what do I know? Um, Always love your time. I think that, again, what everybody's waiting for is not necessarily the foregone conclusion of this week, but the things that you talked about, some of the data points behind it and some of the commentary on the back of it. And we'll see how the market reacts. But in the meantime, it's all systems go, not only for the U.S. equity market, but for the sports franchises that find themselves domiciled in the great state of Wisconsin, Elizabeth.
Yes, go Packers, go Brewers. Fall baseball well on its way. I'm so excited, and the Packers season hopefully stays hot even after that's over. So
Well,
we're
we
gonna
can
just
only
sail
hope.
right through into February.
And then, of course, you got the Bucks, which we never know, and it always sort of. I don't understand why Milwaukee doesn't have a hockey team. It would seem a logical city for there to be a hockey team.
It would, but it's just I think it's the population isn't big enough to support that many professional sports teams.
I
Plus,
see. I see.
Chicago's right there, and you've got the Blackhawks.
Yes, you do. Yes, you do. Much to the chagrin of Blackhawk fans over the last few years. But I digress. Elizabeth, we'll talk soon.